The other thing I would just sort of layer on to what you said that is something I didn't really fully appreciate until all of this broke down the way that it has is I think there is a big distinction between consumer protection and safety and soundness, right? And so when you were saying before about regulators were sort of waiting and watching and waiting to see what would happen, they were waiting and watching to see what would happen in terms of what would break with, I think, a decent comfort level that the banks that were involved in this, if it was to go as bad as possible, it still probably wouldn't pose a safety and soundness issue for the US financial system. And so one of the things I've been troubled a little bit by is, when you see like the FDIC, for example, talk about the Synapse failure, they talk about it more in the language of, well, there's been no impact to the insurance fund, and this isn't posing a risk to safety and soundness of the US banking system. So from our perspective, and they don't quite say this, but like you can read between the lines, this isn't a failure, right? Like nothing got broken here. Like this is fine. And of course, anyone who's not solely responsible for that is looking at it and going, what if, of course it's a failure, right? Consumers are having their life savings locked up in these apps that they can't get out. And so I do think drawing a bit of a distinction between when you talk about like the worst case and, hey, if you screw this up, bad things can happen. The penalties and the downside need to be linked, I think, to both consumer harm and safety and soundness, not one or the other, which I think has been kind of the weakness of a lot of regulation at a federal level, where it's either the CFPB, which has a set of concerns and a way of looking at the market, or it's the OCC, FDIC, and Fed, and they have a different way of looking at it. And really what we need in terms of disincentives is a blended model where both consumer harm and safety and soundness are equally bad outcomes that as the administrator of these programs or the sponsor, you want to avoid.
Well, let me pin those two things together.
Yeah.
The first is, I find it ironic that the FDIC in particular is taking this wait and see, step back response, but has been very active about the placement of the FDIC logo in the terminology.
Yes.
Like, no. We all knew FBO was going to be an issue. We all knew that things could go wrong. And I think those who are steeped in it are, also very clear. It's like, hey, unless the bank fails, FDIC insurance doesn't work. Right. Yet the FDIC is letting all of the startups, myself included, be a culpa on this, right? Like we advertised at Brook Street, FDIC insurance. Our difference was we had a one-to-one relationship that every account was an account on Fiserv.
Right.
It was ultimately part of our undoing because the unit economics do not work. Not talked about enough. Everyone's like, oh, like the cores aren't, set up for this kind of technology. No. The cores are actually basically not willing to give up on, their
pricing.
economics.
Yeah.
Right. So they're like, no, we paid 65 cents per account, whether someone used it or not, every month.
Right. Which kills you as a startup when you're just like, a little side piece to a consumer that they're testing out like that destroys your unit economics.
Yes, exactly. And so this approach that the regulators took around, hey, let's take a wait and see until it plays out, has now become a much bigger issue that they're trying to like stuff back into the bottle. And it's like, no, you saw it. You dabbled on the edges of it.
Yep.
But you should have gone in and more active sooner. And I think when you look at the best banks that do banking as a service, they're the ones, despite not having regulatory pushback, invested anyway.
Yes.
And then you had a host of banks that said free money, jumped in.
Yep.
And so I think the thing to pin together what you talked about is how do we regulate this is you actually need regulators that are going to be more prescriptive than they are normally comfortable doing to say, here's what we think safe and sound looks like. Because the problem is the consumer does not actually distinguish when it said FDIC insured. They don't understand that Mercury is not a bank. Aspiration is not a bank. Chime is not a bank. It said FDIC insured. So the safety, and I know Kia Haslett from bank director, and we're part of a group that we fight about this all the time.
Yeah.
Yes, legally you can say the safety and soundness of the banking system is not impacted.
And she's a big buyer beware person, like, read your terms and
Yes.
conditions, which I'm generally sympathetic to. But I mean, you and I have read these terms and conditions. Like, I can barely parse what the terms and conditions of a fintech program are and
Yep.
what it means in terms of what's covered and what's not. I mean, it's ridiculously complex. There is no rational expectation, I don't believe, that a consumer can or should be able to parse that. And to your point, in terms of regulators being more prescriptive, the other thing that I think is really interesting is, as you said, regulators aren't comfortable being prescriptive, because the more prescriptive you are, the more you are locking yourself into a set of rules that then people can find creative ways to get around. So you don't want to be
Or you're
prescriptive.
held accountable.
Right. Like you said, this was the safe way to do it. And now look what happens. So you want to be vague if you can be. But like, just as another example of this, even when it's the bank failing and not the fintech company. So let's say kind of a reverse synapse where
Yep.
it's not, the fintech program that gets all kind of locked up, or it's middleware provider, it's the bank. Even in that scenario, FDIC pass-through insurance, which would pass through to the individual programs on that bank, that doesn't necessarily apply if certain conditions aren't met. And you only know that after a bank has failed and the FDIC goes in and examines the records and how everything was structured. And then they determine if FDIC insurance is passed through or not. And so, to your point about like consumer awareness and how do we help consumers shop, like, is this a good fintech or a bad fintech? That's ultimately the question we need to answer. And unless like there's an FDIC stamp on there that says FDIC pass through insurance if the bank fails will apply in this case, because we have proactively looked at the arrangement and the way that records are kept, and we feel comfortable with that. And there's some level of protection or guarantee on the fintech failing. Absent those things, I just don't know how consumers are supposed to make this choice.
Well, and this goes back to the fundamental nature of the banking system is a purveyor of trust.
Exactly.
Right. And this is putting ambiguity into that trust system. And so where Kia could argue, hey, legally, there is a line here that they do not oversee the fintech, which I agree with.
Yeah.
Legally, she is correct. But safety and soundness in the system, the number of times I have sat in meetings with executive teams of banks, with regulators, talking about reputational risk, this is reputational risk, but it is on the regulators for the first time. And so their reputation on safety and soundness is at stake.
I could not agree more. That's a perfect way to put that.